Here's a number that should stop you cold. The average retiree has over $300,000 sitting in home equity right now, and it's generating exactly $0 of income for them, not a penny. Meanwhile, that same retiree is watching their savings account like a hawk, stressing over every withdrawal, wondering if the money is going to last. But here's what makes this so frustrating. The solution to that income problem isn't in the stock market. It isn't in CDs or bonds or some complicated annuity your broker is trying to sell you. It's literally underneath your feet. Therefore, today I'm going to show you exactly how retirees are turning their home equity into real, spendable income, without selling, without moving, and without giving up the home they've spent a lifetime building. Stay with me, because about halfway through this video, I'm going to show you a strategy that most financial advisors aren't talking about, one that academic researchers say can dramatically extend how long your retirement savings last. It's not what you'd expect, and you're going to want to see it. My name is Rich, and I spend way too much time thinking about retirement income. Specifically, why so many retirees are sitting on a gold mine and treating it like a storage unit. If you're someone who has worked for decades, paid off your home or come close to it, and you're still sitting there every month wondering why your financial situation doesn't feel as comfortable as it should, make sure you hit that subscribe button and give this video a thumbs up if it helps you out. On this channel, we talk about real retirement income strategies for real people. Not theory, not generic advice, stuff you can actually use. Let's get into it. Number 1. The belief most retirees have and why it's costing them. Here's the common belief, and I want to say it out loud because I know a lot of you have heard it your whole life. Your home is your nest egg. Protect it. Don't touch it. Pass it on. That belief made complete sense when you were 40 years old and still building wealth. It was good advice. But here's the thing. That advice was written for accumulators, and you are no longer accumulating. You are distributing. But most retirees never got the memo that the rules changed. Therefore, they sit on hundreds of thousands of dollars in equity, draw down their investment accounts faster than they should, and feel financially squeezed, even though they're technically wealthy. Let me show you what I mean with real numbers. Let's say you're 68 years old, your home is worth $420,000, you have a $350,000 investment portfolio, and your Social Security plus a small pension covers about $3,200 a month, but your actual expenses run closer to $4,200. That's a $1,000 monthly gap, $12,000 a year, that you're pulling from your savings. At that rate, your $350,000 portfolio is gone in under 30 years, even before you account for taxes or a bad market run. But here's what most retirees don't realize. That $420,000 home isn't just a place to live. In the right strategy, it's a financial tool, and it can close that $1,000 monthly gap without touching your investments at all. Therefore, the question isn't whether you should use your home equity. The question is, which tool is right for your situation? And that's exactly what we're going to break down. Number 2, the 3 tools, and the one most people get wrong. There are 3 main ways to access home equity without selling. A HELOC, that's a home equity line of credit, a home equity loan, and a reverse mortgage. Now, most of you know the first 2 at least by name. But I want to start with the one that can move the needle the most, and it's also the most misunderstood financial product in all of retirement. I'm talking about the reverse mortgage. And I know what some of you are thinking right now. You're thinking about those late-night infomercials from the 1990s. You're thinking about horror stories you may have heard. You're thinking your kids warned you to stay away. But here's the thing. The product those infomercials were selling is not what exists today. The modern reverse mortgage, specifically the FHA-insured home equity conversion mortgage, or HECM, has been so significantly reformed and regulated that comparing it to the old product is like comparing a 1975 car with no seatbelts to a 2024 car with 12 airbags. Same category, completely different safety record. Therefore, I'm going to give you a real, honest look at how it works, the benefits and the real risks, so you can make an informed decision instead of a fear-based one. Here's the core mechanic. If you're 62 or older, you can borrow against your home equity. But, and this is the part that surprises most people, you make no monthly mortgage payments. The loan doesn't come due until you permanently leave the home, sell it, or pass away. At that point, the home is sold, the loan is repaid, and any remaining equity goes to you or your heirs. You own the home the entire time. The bank does not take your house. That's a myth. Let's put real numbers on it. You're 70 years old. Home is worth $450,000, no existing mortgage. Depending on current interest rates and your age, you might be eligible to access somewhere in the range of $200,000 to $250,000 through a HECM. You can take that as a lump sum, as a growing line of credit, or as monthly payments that land in your bank account like a paycheck for as long as you live in the home. That monthly payment option? Let's say it delivers $900 a month to you. Combined with your existing income, that $1,000 monthly gap we talked about earlier, gone. And you never made a single loan payment. Now, before we go further, let me be direct about the real risks, because this is where a lot of people get misled. Reverse mortgages come with upfront costs. Origination fees, closing costs, and mandatory FHA insurance premiums can add up to several $1,000s. If you're only planning to stay in your home for 2 or 3 more years, those costs may not be worth it. This is a tool for people who plan to stay in their home long term. But there's another risk people don't talk about enough. If you fail to pay your property taxes, maintain homeowners insurance, or keep the property in reasonable condition, the loan can be called due. That's how people have lost homes to reverse mortgages, and it's a real risk you need to take seriously going in. Therefore, a reverse mortgage is not a magic solution. It's a powerful tool in the right hands, in the right situation, and a dangerous one if you go in without understanding the obligations. Number 3. The HELOC. The tool. Most retirees should open right now and never use. Now let me shift to what I think might be the most underutilized retirement strategy for homeowners who don't need income right now but want to protect themselves against risk. It's called a standby HELOC, and I want you to hear me on this. A home equity line of credit works like a credit card backed by your home. Your lender approves you for a credit limit, let's say $200,000, based on your equity. You open the line, you pay nothing, and it sits there. That's it. You just let it sit. But here's where it gets really interesting. That open line of credit becomes your financial emergency exit. When the furnace dies in January, you pull from it instead of selling investments. When the market drops 30% in year 2 of your retirement and you don't want to lock in those losses by liquidating, you pull from the HELOC to cover your living expenses, let your portfolio recover, and pay the line back when things normalize. The research on this is compelling. Selling investments at a loss early in retirement, what's called sequence of returns risk, is one of the greatest threats to a retirement portfolio's longevity. A standby HELOC can act as a buffer that lets you sidestep that risk entirely. But there's a catch. HELOCs have variable interest rates that can rise. And critically, lenders can reduce or freeze your line if your financial situation changes or if home values drop. So you cannot treat it as a guaranteed safety net. It's a tool, not a promise. Therefore, the best time to open a HELOC is before you need it, when you're still in good financial health and home values are strong, not when you're in crisis. One more thing, some retirees run into issues qualifying for a HELOC because their income looks different on paper in retirement than it did during their working years. Bring pay stubs, Social Security award letters, pension statements, and investment account statements when you apply. Lenders want to see the full picture. Number 4. The strategy most financial advisors aren't telling you about. Okay, this is the part of the video I told you to stay for. And I want to be careful here because this is genuinely sophisticated, but once you see it, you won't be able to unsee it. It's called the coordinated withdrawal strategy, and it involves combining a reverse mortgage line of credit with your investment portfolio in a way that can meaningfully extend how long your money lasts. Follow me here. When you open a HECM reverse mortgage as a line of credit, something unusual happens. The unused portion of that credit line grows over time, at the same rate as your loan interest rate. That means the longer you leave it untouched, the more available credit you have. But here's how the real strategy works. In years when your investment portfolio is performing well, you withdraw from the portfolio normally. You don't touch the reverse mortgage line. You let it grow, but in years when the market drops significantly, say your portfolio falls 25%, instead of selling depressed investments to cover your living expenses, you draw from the reverse mortgage line of credit. Your portfolio sits. It recovers. You haven't locked in those losses. When the market recovers, you have the option to pay down the reverse mortgage line if you choose. And your portfolio, which you protected during the downturn, is now larger than it would have been if you'd been forced to sell at the bottom. Dr. Wade Pfau at the American College of Financial Services, one of the most respected retirement income researchers in the country, has published research showing that this kind of coordinated strategy can, in some scenarios, extend the life of a retirement portfolio by a significant margin. Some of his research suggests the difference can be measured in decades. But I want to be honest with you, this strategy has costs. Reverse mortgages aren't free. Interest accrues on whatever you borrow. Upfront fees exist, and this requires real planning and discipline to execute well. Therefore, this is not a strategy you implement based on a YouTube video. This is a conversation to have with a fee-only retirement income planner, someone who has no financial incentive to push you toward any particular product. What I want you to walk away with is this. Your home equity doesn't have to be a passive bystander in your retirement. For the right person with the right planning, it can be one of the most powerful assets in your entire financial picture. Number 5. The home equity loan, and when the math makes it obvious. Let's briefly cover the third tool, the home equity loan, because for some of you watching, this is actually the most immediately useful option. A home equity loan is straightforward. You borrow a fixed lump sum at a fixed interest rate and pay it back in fixed monthly installments. No variable rates, no surprises. This is the right tool when you have a specific known expense. Here's an example where the math is almost impossible to argue with. You have $35,000 in credit card debt at 21% interest. That's costing you $7,350 a year in interest, just to stand still. A home equity loan on that same $35,000 at 7.5% costs you $2,625 a year in interest. That's a difference of nearly $4,700 back in your pocket every single year. But, and I'll say this clearly, you are converting unsecured debt to secured debt. Credit card companies cannot take your house if you fall behind. A home equity lender can. You need to be confident in your ability to make those fixed monthly payments before you make this move. Therefore, this isn't about whether the math works. It clearly does. It's about being honest with yourself about your income stability and your spending habits going forward. If you consolidate $35,000 in credit card debt with a home equity loan and then run the credit cards back up, you've made your situation dramatically worse. This tool rewards discipline. Number 6, your action plan this week. Here's what I want you to actually do with this information. Step 1, know your number. Look up a current estimate of your home's value on Zillow or Redfin. Subtract what you still owe. That's your equity. Write it down. Step 2, identify your income gap. Look at last month's bank statement. What did you actually spend versus what came in from Social Security, pension, and investment distributions? If there's a gap, or you're draining savings faster than you'd like, that number is what you're solving for. Step 3, if you're considering a reverse mortgage, you are legally required to meet with a HUD-approved housing counselor before you can proceed. This is a free service. These counselors are independent. They're not selling you anything. Use them. They are genuinely useful. Step 4. If a HELOC interests you, call 2 or 3 lenders this week and ask about current terms, qualifying requirements, and whether a standby HELOC makes sense for your situation. Get it while you don't need it. Step 5. Bring all of this to a fee-only financial planner, not a commissioned advisor. Fee-only. Look for a CFP who specializes in retirement income distribution. Ask them specifically about coordinated withdrawal strategies involving home equity. The fortune cookie. Here's the thing I want to leave you with. You didn't get to this point by being reckless. You got here by being responsible, by making payments, staying the course, building equity slowly and steadily over decades. That discipline built something real. But discipline that keeps you from accessing the tools you've earned is no longer discipline. At some point it becomes fear, and fear is not a retirement strategy. The retirees who are thriving right now, the ones with flexibility, with peace of mind, with options, they didn't just save more. They learned how to use what they already had. You've built the equity. Now it's time to decide whether it works for you or just sits there while you worry. If this video helped you see your retirement picture differently, please hit that thumbs up. It genuinely helps this channel reach more retirees who need to hear this. Subscribe to Rich Retirement if you haven't already, and drop a comment right now. Do you own your home outright? Are you close? Have you ever considered any of these strategies, or have you avoided them because of what you've heard? Tell me where you're at. I read every single one. I'll see you in the next video.